Well, let's take a closer look at the broader markets. Let's bring in our market panel. We have Seana, President of Pacer ETFs, and Harley Bassman, Simplify's Managing Partner. Welcome to you both. So, Harley, I first want to start with you. How would you characterize the action that we're seeing in the markets to end the week?
All we're trying to do is basically process the Fed, process inflation, process interest rates. They've kind of told us what's going to happen over here, and it's going to play out a little more than people thought, but very slowly. And the market's got to go and adjust for the fact that we're going to have, higher rates for the next 6 months or so.
So, Sean, what do you think that means for the market action over the next couple of months? And did you hear anything this week, either from the Fed or from the jobs report this morning or earnings reports, that really made you maybe change your view about the coming months?
Well, thanks for having me. No, nothing I heard this week really changed anything other than the resounding announcement this morning on the job side, which sort of gives cover to the Fed to continue their path forward in terms of aggressively raising interest rates. And so for the entire year, that's been the theme. High inflation, high interest rates means lower PEs. We're seeing those PEs come down. They're now sort of still above historical levels, but down quite substantially. But that doesn't mean that they can't continue to fall. And so the advice we've been giving to people all year long is it's time for you to lower your overall portfolio's PE before the market does it to you. It's done a fair amount, and it probably can continue to do some more. But there are places in this market to make money. I think if you buy high-quality stocks with high free cash flow or a high free cash flow yield, you can buy stocks that are cheaper than the overall market and less susceptible to that multiple contraction that always seems to go hand in hand with rising interest rates and rising inflation. And the two standouts in our largest ETF, the two standouts, our two biggest sector weights are in energy and healthcare, with a little tilt. The third would be materials. And so we've been positioned pretty well. And that fund is a large cap U.S. fund that's basically up for the year, even though the market's down more than 20%.
And obviously, we tend to watch the bond markets for any sort of signals anytime the Fed speaks. So, Harley, you're known as the convexity maven. Talk about the movement that you're seeing in bonds and what the volatility there is telling you.
Well, rate volatility is very high. So the MOVE index, which is the VIX for bonds, is running around 140, 150, which is basically, it's crisis levels. But the reality is the market is moving that much every day. So it's legit. The contrast, of course, is the VIX at 25, which is not that far above its long-term average. Stocks are down 20%, but it's been an orderly decline. We just don't know how far the Fed's going to take us. And that's the uncertainty in bonds, and that's why they're gapping up and down so much. But I will tell you that my view is that we're getting near the peak for the front end. The Fed might take rates to 4.75, maybe 5%, but the 2-year where it is right now is probably pricing in about the right number. And what we don't know is the back end. Longer term rates have not risen up. The curve's inverted, and the inversion in the market yield curve is very good at calling recessions, and it's calling for one next year, and the market's pricing it out for a recession sometime next year. Will we get that? I don't know, but that's the uncertainty of the stock market, is we can't tell if earnings are going to drop or not. But the bond market, they've kind of got this thing pegged.
Convexity maven, Harley, I like that. Sean, let me ask you about what you said earlier here when you talked about an aggressive Fed. What do you think is most likely? I guess, do you think a 75 basis point hike is on the table? And how much of that has been priced into the market, if at all, at this point?
Yeah, so some of it probably has. I think it's likely that you'll see 75 basis points out of the Fed this next move, only because the job market continues to remain fairly strong. I think the things to watch from the Fed side is if they start to see, massive demand destruction in terms of the overall economy, and you start to see unemployment start to rise, then they'll be in a position where perhaps they need to sort of ease up a little bit. I think that's what we're all hoping, at some point, that the Fed will ease, but I don't think I got anything out of what Chairman Powell said this week and any of the recent actions that would let me come to the conclusion that they're going to do anything other than what they said, which is continue to aggressively raise interest rates to try to tame inflation.
Sean, what about the risk of the Fed going too far? Do you think that is a possibility up until this point?
They hardly ever get it right. So, they probably will go too far. I have, a different view on what the real problem is right now. I don't think it's an overheated economy. I think it's energy prices that are driving inflation across all parts of and all sectors of our economy. And I think that's a supply issue as opposed to a real interest rate driven solution. And so they probably will get it wrong. The thing that you have to keep an eye on that will tell you whether they're really getting it wrong is if inflation starts to peak or pick up. And then guidance is really the most important thing going forward. So you've got a range on S&P earnings for next year, somewhere between $200 a share and $233 a share, so perhaps at the high end. But as these companies start to get through this fourth quarter and start to give us a little hint for what's coming forward, if we see guidance sort of wane a little bit and move towards the downside, then that'll tell you that we're probably not going to have as soft a landing in the stock market as the Fed really wants.
So, Harley, if we go by their mantra, don't fight the Fed, what does this mean for how people should be balancing their portfolios in preparation for a recession as you're expecting in the next 12 months?
Well, I would push back on our other guest over here a little bit. I think the Fed goes 50 next time. I think they're going to go higher than we thought, but they're going to get there slowly. They've already done 4 big hikes over here. The medicine has to kind of work for a little bit. I also don't think that's actually oil, energy per se. I think labor. Cost of labor is the real driver over here, the demographics underlying that. What I like in the market, though, I think muni bonds and mortgage bonds have gotten crushed, and they're very solid, they're very safe. You're not taking credit risk with those securities. So if we do get a recession, we do get the down earnings, we do get the unemployment, you're not going to get hurt with those 2 investments.
Harley Bassman, Sean O'Hara, we'll have to leave it there. Thanks so much for joining us. Have a good weekend.